and welcome. This is the first in a series of lectures we're going to produce talking about the topics and concepts in managerial accounting. What we thought we'd start with in this first lecture are some of the differences between financial accounting that you've just studied and managerial accounting. We thought we'd start with the history. We're not 100% positive who invented financial accounting. Our best thoughts on the subject is about 600 years ago, the seafaring people in Venice, Italy, came up with a system of double entry bookkeeping to help them keep track of whether or not they were making profits as they loaded up their ships with possessions, sailed off, exchanged them, and came home. Managerial accounting, on the other hand, is not quite as old. About 150 or 200 years ago, with the start of the Industrial Revolution, entrepreneurs were bringing in skilled craftsmen from different parts of the country and the world into one location so that they could achieve economies of scale and mass produce their goods, bringing down the price. But the financial accounting systems available at the time weren't helping them to determine the cost of each individual unit as they were making that. So there's differences between the two. The foundation is basically the same with journal entries and debits and credits, but there are some distinct differences. The first one is that in financial accounting, there are rules that must be followed. Those rules are called generally accepted accounting principles, or GAAP. The revenue recognition principle, the matching principle, the expense recognition principle, and so on down the line. They give us the guidance we need to help prepare the financial statements that a company will publish and use for analysis and decision-making in what they're doing. But in managerial accounting, there are no rules. Basically, it can be done any way that you like to do it. What we're going to be discussing in the class are some things that we've come up with over the last 150 or 200 years that seem to work well to help give managers the information they need to make good decisions about what's happening in the company. Another difference between the two of them is that financial accounting is almost always based on things that have happened in the past. An accountant will analyze a transaction that's already occurred and journalize it into the general journal. They will then summarize that by posting it to the general ledger, and at the end of the accounting period, group all of that summarized information to prepare an income statement to show how much money they earned, past tense, in the last month, the last quarter, or the last year. It's all based and focused on things that have already happened. Whereas managerial accounting is very much focused on the future. Some of the important topics that you'll cover in the class are budgeting, putting together a financial plan for next year, and decision-making on what we can do today to improve our operations and our profits over the next month or two or three, trying to predict what our costs will be next month and so on. The third thing is, part of the reason why it's not important that there aren't any rules is who uses this information. As I mentioned, financial accounting is the preparation of financial statements that are going to be published and given to the world. The people that use this information are people that are outside the company. Not employees, but people outside, such as creditors, looking at the income statement and the balance sheet to decide whether they can sell to us on account or whether they want us to pay cash. Potential investors, trying to decide whether the company is profitable enough that they want to put their hard-earned money as an investment in the company. Lending institutions, looking at the financial statements to try and decide whether they will be willing to lend the company money or not. Managers inside the company do look at this, but stop and think about it. Because the information is based on things that have already happened, they can't change it. So their attitude is like, okay, how much money did we earn last month? $100,000, very good. Boom, what are we going to do next month? The future focus, to make that better. They can't change what's already happened. So the focus on our managerial accounting, the information here is used by people inside the company. the insiders, management looking at the numbers to decide, can we improve this operation? Can we cut these costs? Should we do it this way? Should we do it that way? All of these decisions that will affect the profits of the company, but based on what we think is going to happen, and budgeting and planning and deciding. So there are some of the major differences between the two items. Thank you very much. We'll see you next time.